All right, so let's open up Chapter 8, Static Exercises. And let's talk about what's going on here in Chapter 8. So up until this point, every single time you have dealt with accounts receivable, it's been really subtle, but what we have assumed is that 100% of our customers are going to pay, and it's not going to be a problem, okay? In Chapter 8, we get into the whole idea of how do we treat customers that don't pay, okay? And so we're trying to decide, one, we go through the whole process of, do we offer credit? Now, understand what's happening before we do that is we're checking, credit scores and all that kind of good stuff and everything, and maybe even we require some recommendations or something from previous folks that they've dealt with, do they pay on time, all that kind of good stuff. And so then we decide how much are we going to offer them. So it just depends on, how well our standards are met, etc. We might offer one company $1,000 worth of credit versus we might offer somebody else $5,000 worth of credit. And it just depends upon, how we think, we're going to get paid, and do we trust them enough to give them more credit, okay? So understand this. Remember that it's a little bit like offering a company, when we're doing this sort of stuff, it's like we're offering them internal credit. So when they say put it on my tab, we are the ones that are financing that delay in getting the cash in. Now, we remember that the cash is absolutely the lifeblood of our business. If we run out of cash, we're done, right? So having to finance outside credit to some of our other customers can get a little tricky. Now, we're going to talk about this a little bit, but just realize that this is not the same as making a decision as to maybe when we first start our business, we're a cash basis business, and then suddenly we decide to accept credit cards. That's not what we're really doing here, because when you're accepting credit cards, you actually receive that money usually within, I don't know, probably within about a week, just depending on what kind of credit card it is. And they just take a discount on that, which we look at here in a little bit. So this is like, you came to me and I said, sure, I'll float you that 10 grand, whatever it might be, okay? Now, in this chapter, remember that we always have to go back to Chapter 1 and trying to remember and decide how are we going to treat something like this. So if we go all the way back to Chapter 1, if you remember the concept of matching, right? So if we're going to record X number of dollars in revenues, we have to show all of the expenses that it takes to earn that amount of revenue, okay? So what we have to do when we're doing this, just try to keep this piece in mind. In the month in which a credit sale is made, and I emphasize the word credit sale, when a credit sale is made, that's when we go ahead, we have no idea who is not going to pay, but we've got to estimate how much of that amount is going to be written off, okay, in bad debt. Somebody's not going to pay. Now, when we first start doing this kind of stuff, we don't have anything to base it on, so it might be a little bit tricky. It might take us a year or two after we start offering credit to determine what those amounts are going to be, okay, because we don't have anything to base it on. We might be able to base it on what everybody in our industry is doing, but we'd have to see how that would work. What else was I going to tell you? All right, so when we make the estimate, okay, when we make that estimate, we effectively are reducing accounts receivable and recording the expense. So just realize we're coming up with one additional account, right? Well, two additional accounts that we haven't looked at yet. One is reducing receivables, so now receivables is now a net number, okay? Then we've got the expense on the other side. So try to get this picture going in your head, because this is where most students sort of lock up on me on this chapter, is that in the period in which we make the sale, we have to make the estimate on how much is not going to be collected, and that's the period in which we actually see a reduction in net income, in the period in which we make the sale, because of the estimation. Sometime later down the road, and understand that in the book, they sort of act like when we get ready to write off an account, they start to act like, we're, 3 months later we write off the account, and then, another month later they pay, and then we reestablish it. No, we're not going to do that. Understand that what is happening in between that point of making the sale and making the collection, even if the collection is late, we have sent letters, we have made phone calls, we have, maybe even gotten an attorney involved. We might have gotten a collection agency involved. I mean, there's all kinds of things that are happening there, because one of the last things that we want to do is to have to actually write off that account, because understand that accounts receivable that we're having to write off was top line revenue. To be able to recoup from that, we have to sell probably, just depending on our profit margins are, we might have to sell 2, 3, 4 times as much revenue to make up for that write-off. You with me? So write-offs are pretty notable, and we've got to record them properly. Let me also say that if you're in the accounting and finance major, let me just say that a really good accounts receivable clerk is absolutely worth their weight in gold, because you have to understand they are driving the cash flow of the business. And if these folks can stay on top of everything that is coming in and everything, and facilitate getting that stuff done and identifying problems early and all that kind of good stuff, you can't replace that. So if you're in the accounting and finance major, maybe being a bookkeeper, an accounts receivable clerk, that kind of stuff, maybe that's the direction that you go in. Okay. All right. So evaluating the decision to extend credit. So let's look at this one. So it says Nutty Productions Incorporated generated service revenue of $30,000 and income from operations of $10,000, which means that the expenses were $20,000, right? Okay. Company estimates that it had extended credit. If it had extended credit, it would have instead generated $60,000 of service revenue. So look at what's happening there. We're saying that we could have doubled our sales had we started offering internal credit. Now, this is pretty common. Now, as far as the percentage goes, it probably is more industry specific as to how much that would have increased, but just realize this, that when we make the decision to accept credit cards in addition to cash, when we are a business, we know that pretty much our sales will see a 15 to 20% increase just by accepting credit cards. Okay? So in this case, it's going to double our service revenue. But it would have incurred $25,000 of additional expenses for wages and bad debts. So look at what's going to happen here, right? Our revenue is going to increase by $30,000, but the additional expenses to earn that $30,000 is going to cost us another $25,000. So our net income would go up by $5,000. Okay? So should these using these estimates, calculate the amount by which income from operations would increase or decrease. Well, we just figured out that it would increase by 5,000. Okay. All right. So now so one of the big things here in this chapter is we have to start thinking incrementally. Okay. And then the question is, should the company extend credit? Yeah. Now, keep in mind though this. You do have to realize that these are estimates. We have to stay on top of them. We have to go back and we have to review them again and again and again. This was what we thought was going to happen, what really did happen, and is it worth it? Okay? Because again, I always tell businesses, it's like getting business that you have to pay for isn't worth having. Okay? So watch that kind of stuff. I mean, everybody wants to see a nice big fat, increase in their net income and all that good stuff, and that's great, but you got to be careful because sometimes overall it might be worth it, but a specific customer may be the problem. And guess what, guys? It's okay to fire a customer. Okay? All right, how we doing there? Okay? All right, so we've got some additional questions and everything on this whole decision to whether or not we can, should offer credit. So that's 8-1. All right? So let's take a look at this one. Okay? So reporting accounts receivable and recording write-offs using the allowance method. Now, remember that the allowance method is what is happening when we're making the estimate. We're establishing the allowance or adding to the allowance, okay, or possibly even reducing the allowance and affecting the income statement with the expense, okay? So when we're talking about the allowance method, we are focused in on that one journal entry of where we're making the estimate, okay? All right, so on this one, it says on December 31 of 2023, Extreme Fitness has adjusted balances of $800,000 in accounts receivable and $55,000 in allowance for doubtful accounts. So how much, as Extreme Fitness, that's us, how much do we think is collectible? Good, $745,000 is what we believe is going to be collectible, okay? Now we think that 55,000 of it ultimately will be written off, but at this point, do we know who?
Where did you get that number from?
Which one? Which number? The 745,000 is the 800,000 in accounts receivable minus the 55 in the allowance. Okay, so that's what we believe is going to be collectible. All right, then. So that's the amount of cash flow that's going to be coming in, all right? The 55,000, we don't know who, okay? We've got to make sure that we understand that. That's just the estimate that's sort of hanging out there. We're waiting for whoever it's going to be to show up. On January 2nd of 2024, the company learns, so we're, 3 days later? The company learns that certain customer accounts are not collectible, so management authorizes a write-off of these accounts totaling $10,000. Now, you need to understand something here, and this is where this sort of mind bender sort of kicks in. When we say write-off, that's when we know who. But understand, the write-off is going to come out of the accounts receivable and come out of the allowance at the same time for the same amounts, which just simply means that our net receivable doesn't change. We're going to look at that here in a minute. So when we see that word write-off, everybody always wants to think expense, but we've already expensed it when we made the estimate. So don't go there. We're just figuring out who. Yes. Okay. All right. So what amount would be the company report as its net receivable? Well, we just said that. That was the $745,000. That's just simply the $800 minus the $55. Okay. That's what we believe is actually collectible. All right? Prepare the journal entry to write off the accounts on January 2nd of 2024. So understand, we're reducing the accounts receivable, which means accounts receivable is going to get a credit. And that was it 10? Yep, 10,000. Now, if your brain is like fried at that point, again, don't stop. Remember, you know that journal entry has to balance, so we just went from failing to passing with a C. What does the debit go to? The allowance for the doubtful accounts. Okay? So again, remember, one of the things that we added in this chapter is this concept called net accounts receivable, right? In the previous 2 chapters, remember we talked about net sales, right? So it was gross sales minus returns and allowances minus discounts. Now we've got net accounts receivable. So we've got accounts receivable minus the allowance, okay? All right, but again, one of the things to notice here, there are no expense accounts on this journal entry, okay? All right. Then it says, assuming that no other transactions occurred between December 31 and January 3rd, what amount would the company report as its net accounts receivable? Okay, now, let's, all right, hang on a minute, let me get a pen. Because when you see this, I think it's easier when you see it. So remember, what did we start off with as our balance in accounts receivable? 800,000, right? And the allowance had how much in it? 55, right? We took those two together and we got $745,000, right? Okay. When we post that $10,000 journal entry, remember, we're reducing accounts receivable down to 790, and the allowance goes down to 45. You with me? So now, what's the difference between 790 and 45? $745,000. That feels a little weird. You with me? I'll see if you scrunched eyebrows. So again, when we write off an account, we are completely out here on the balance sheet, and the net accounts receivable doesn't change. That feels weird. Okay? So it's still $745,000. You see where I'm going? Yeah. So 800 minus 55 is 745,000. 790 minus 45 is $745,000. Okay? Because both accounts are being reduced by the exact same amount. We're just netting together lower numbers. Okay? So it has no effect on net accounts receivable. All right? Let's look at the next one. So has net accounts receivable changed from December 31 of 2023? The answer is no. How are we doing there? You got it? Okay. The biggest thing is hopefully it'll stick, right? Okay. All right. Do we need to do another one of those? All right. Let's take a look at number 4. All right, on December 31, 2023, Extreme Fitness has adjusted balances of $800,000 in accounts receivable and $55,000 in the allowance. So this one is exactly the same. So again, let's look at the T accounts. We've got 800 and we got 55. All right. January 2nd, company learns. This one's exactly the same. Exactly the same. All right. Let's see. Hang on. I was hoping that was going to be a little bit different. All right, let's put a pin in this one for a second. Let me find another one that was. All right, so at this point, right, we've got the accounts receivable, we've got the reduction where we figured out who, that was the 10,000. So again, we're still in that exact same mode of 790,000 in accounts receivable and 45 sitting out here in the allowance. All right, now understand what just happened there. When we figured out who, we made this journal entry for $10,000. Okay, and notice what's happened here. Within that $10,000, notice it says, assume that on February 2nd, Extreme Fitness received a payment of $500 from one of the customers whose balance had been written off. So that $500 was included in that $10,000. Okay, so we wrote it off. We thought, we're never going to get that $500. So then it says, prepare the journal entries to record this transaction. Now, let me be clear. They want 2 journal entries. It can be done in one, but just realize that it's like in the real world, it can be done in one journal entry, but they want 2, okay? Because they want it very specifically in a certain way. So 1, it says, record the reversal of a customer account previously written off in the amount of $500. Now, let me give you a picture of what's going on here. You've written off that $10,000. You show up at the post office one day, take in the mail, and you're opening up checks, and lo and behold, you got a $500 check sitting there from the company that you just wrote off their account. Now, that's the scenario here. So let's go with that, and then I'm going to give you another example of something that's a little bit more realistic. So remember, we wrote off that $10,000, so now we got to get the $500 back into accounts receivable. You following me? Right? So we've got to add that $500 back to accounts receivable, and basically what's happening here is we've got to get the $500 back into the allowance. Now, putting the $500 back into the allowance is basically like this. Oh, well, we thought that we were going to reduce that allowance by $10,000. We thought we figured out who, and it's like, well, it must be somebody else. So we're putting that $500 back into the allowance so we can use it at another time for somebody else. Okay? So 1, we've got the $500 debit and credit, right? There's half our points. We then put the accounts receivable back on the books, and we add back to the allowance. Okay? Now, at this point, again, notice what happens here. We've got $790,500 in the accounts receivable, and we've got $45,500 in the allowance. So what's the net accounts receivable? $745,000. Is everybody with me? So we've made, what, 2 journal entries to the accounts receivable and the allowance. Nothing has changed in the net receivables so far. Okay, now watch what happens here. Then it says, record the receipt of cash of $500 from the customer. Now, this one should be a gimme at this point, because cash is going with a, okay, and good, accounts receivable is going down with a credit. So now look what happens. Up here under our accounts receivable, we've got a $500 credit. So now, we'll take that out so y'all can see it. Hang on. So now we've got $790,000 sitting out here in accounts receivable, but we've got $45,500 sitting out here in the allowance. What is the net accounts receivable? How much? Net accounts receivable. Remember, if I say what's the balance in accounts receivable, it's 790. If I say what's the balance in net accounts receivable, it's the 790 minus the 45.5 at this point, right? Which means net accounts receivable is now, no. Come on. Yeah. So watch what happens there. You got now you got a balance of 790 in accounts receivable minus the 45.5. Now the balance in net accounts receivable has changed. But good, because only one of these accounts was hit when we made the cash receipt against the accounts receivable. You with me? So do what? That was the issue that I was mentioning before. You can do this in one journal entry in the real world, but in this case, they want to see it in two journal entries. One, they want to see this journal entry as the reversal, and then this journal entry as the collection. In reality, we would have to do it, I don't want to confuse you. We would actually have to rebill. It would get kind of funky, especially in a computerized environment, because now effectively at the point where we wrote off the invoice, effectively, we'd have to reestablish that invoice, which then I don't want to confuse you. That starts to get a little weird. All right. Now, is everybody following? Because the biggest thing here to note in this particular situation is when we made the cash receipt, we only changed the balance in the accounts receivable, right? Not the allowance. So at that point, we only changed one of the balances in the account, which then means that net accounts receivable changes. Okay? All right, don't lose me. What's another example of one account balance being changed that would also change net accounts receivable? We haven't done that yet. What's another? We haven't gotten to it yet. So in this situation, when we had a cash collection, we changed the accounts receivable balance, right? But we didn't change anything down here in the allowance. What's an example of changing the allowance by itself? When we make the estimate. So when we make a cash collection, only accounts receivable changes. When we make the estimate, only the allowance changes on the balance sheet. When those two things happen, that's when net accounts receivable changes. Okay? All right. Let's look at all right, let's look at this one. Number 5. Prepare journal entries for each transaction listed. So A, at the end of June, bad debt expense was estimated to be $14,000. Now understand, this is when we make the estimate. Okay? Now, there's a lot that goes into that and figuring out how much that $14,000 is, but they're giving it to you right at the moment. So, don't miss anything. Go ahead and give me a 14 and a 14. Oop, not 140. There we go. When we make the estimate, what accounts get hit? Okay, the allowance for doubtful accounts gets the credit, and the debit goes to the bad debt expense. Okay, so there's the example that we were just talking about. Only the allowance is changing, not the accounts receivable balance. We're just simply making an estimate as to what we think is going to be the write-off. Okay. Then it says in July, customer balances are written off in the amount of $7,000. Now again, get as much points as you can, right? That journal entry is $7,000. But when we're writing off the accounts, we've already done that one. Debit goes to, well, actually, let's start with the credit because I think that one's easier. The credit goes to, we're writing off the account. So now accounts receivable is going down with a credit. And the debit is going to the allowance. So that's when we think that we know who. How we doing? So let me walk you through the timeline here, right? We build a customer. We increase sales. We increase the accounts receivable. So net accounts receivable changes. We make a collection. Cash goes up. Accounts receivable goes down. Net accounts receivable changes. We make an estimate as to what we think the amount is going to be. When we make the estimate, the allowance goes up, the bad debt expense goes up, so accounts receivable, net accounts receivable changes. You following me? When we write off an account and think we know who, net accounts receivable doesn't change. When we restore an account, net accounts receivable doesn't change. All right, so let's see. Let's do, I don't think I've given you a timeline on effectively on this in this chapter. Maybe a timeline would be good. Let's do this. All right. So remember, what do we do first? We go out, we do the work, sell the product, right? We record, and we do it on credit. We record accounts receivable for however much that was, and we record sales or service revenue, right? Okay. Only accounts receivable is changing. So net accounts receivable is changing. When we make the collection, right? Cash goes up. Accounts receivable goes down. Therefore, net accounts receivable changes. Okay? Then, we collected the cash. Yeah. Okay? Then, the next thing that we have to do is we have to make the estimate as to who's not going to pay. Right? Within that same month. When we make the estimate, bad debt expense goes up with a debit. The allowance for doubtful accounts also goes up. So net receivables changes.
So when you, I'm sorry.
Go ahead.
Your wording confused me. When you said collections, you just talked about they're paying
Cash. We're collecting cash.
They're paying
They're exactly. Yes. Okay. How we doing? We make the allowance. I'm going to review all this one more time after we get done. Excuse me. We make the estimate. Okay. At some point later, we write off something. Right? If we write off something, the allowance for doubtful accounts goes down and accounts receivable goes down, right? Okay. Both allowance and accounts receivable change, therefore net receivables doesn't change. Yes. Okay. If we have to restore account, the accounts receivable goes back on the books and the allowance goes back on the books. Both change, so therefore net receivables doesn't change. Then, in this particular case, now we're back to we collect the cash from the customer. Okay? So effectively, in this chapter, we're talking about 5 journal entries. It's kind of hard to believe, but we are. We make the sale. We increase accounts receivable. We increase the revenue. Net receivables. Good. Net receivable goes up. We make the collection. Net receivables goes down. We make the estimate. Net receivables goes down because the allowance increases. We write off an account. Both accounts receivable and the allowance changes, so therefore no change in net receivables. When we restore an account, we put the accounts receivable back on the books, we put the allowance back on the books, therefore no change.
Is it easier if we think of like the revenue, splitting it into balance sheet and income statement?
Keep talking.
Like if it's all in your asset, like the sales revenue and the expense account.
Exactly.
So whenever the allowance for doubtful
Accounts.
affected, that automatically affects accounts receivable.
Yes, and so understand, accounts receivable, net accounts receivable, right? It's a calculated number, right? Remember that we're dealing with 2 different accounts on the trial balance now, right? That get netted against each other to show net receivables on the financial statement. Okay? How we doing? So effectively, we got 5 journal entries, and again, they're just sort of in a time, in a chronological order, right? We make the sale on account. We record the revenue. We record the accounts receivable. Some people are going to pay, and it's not going to be a problem. We make the cash collection. We reduce the receivables, increase cash. End of the month, we go, some of these folks aren't going to pay. We make the estimate. Bad debt expense goes up. Allowance for doubtful accounts goes up. Net accounts receivable changes. Then, if we have to restore an account, write off an account, accounts receivable goes down, allowance goes down. If we have to restore it to do the collection, accounts receivable goes back up, allowance goes back up, and then we're back over here on recording the cash increase on the accounts receivable. Okay? How we doing? All right. I need to put that in a document. I don't think I've ever done that before. For those of you online, I am biting the screen. Oh, sweet mercy. Oh, sweet mercy. All right, hang on a minute. When we're looking for net accounts receivable, we have to take into account accounts receivable and the allowance. If they just ask for accounts receivable, they're just asking for that one line item from accounts receivable. All right. All right. All right. We've already talked about that one. All right. Now, so at this point, we're through the process of these 5 journal entries and what we're going to do. Now, when we get to this whole thing of percent of credit sales or the aging method, understand this is simply 2 different methods that we use to make the estimate for the allowance for doubtful accounts. This journal entry right here, the 3rd one. Okay? That's all these 2 methods are doing. Okay? Now, trying to decide whether to tell you a story or not. All right. So let's take a look at this one. So this one is percent of credit sales method. Let me back up and give you some context here so that maybe this will make a little bit more different sense as to why we would choose one or the other. Now, here's the other thing. We can use both of these methods within the same year. That's not a problem. But you remember when we were talking about the differences in the inventory methods, and we were basically like, nope, you choose an inventory method, you stick with that inventory method. If you change that inventory method, you got to restate 3 years worth of financial statements kind of stuff. This is not anywhere near that restrictive, okay? So when we're talking about which methods we would use, think about how easy they are, right? So if you did your reading, the percent of credit sales method, number 1, is the easiest, fastest method because it's like, if we have $100,000 worth of credit sales and 1% of that is our estimate on uncollectability, then our estimate is just simply $1,000. It's super easy and super fast to do. Now, understand something though. You've got to be very careful when you're reading these questions because sometimes they'll say total revenues were $900,000. Well, actually, let's do it differently. Total revenues were $1 million. Credit sales was $900,000. You with me? So what's the $100,000 difference? Cash sales. You with me? So it's like when somebody comes in, somebody might hand you cash versus somebody else comes in and they say, put it on my tab, right? So the big thing to understand here is be careful. You've got to read very carefully because cash sales is still in play. Okay? So if they give you something along those lines of, total revenues are one number and, cash sales are another number, you've got to net it to get to your credit sales, or if it gives you total revenues and credit sales, you're going to use the credit sales number to calculate, to multiply it against your percentage, okay? Because remember, the collectability of a cash sale is 100%, right? So watch out for some little things like that, okay? Okay. Continuing on the story here. So here's why we would use the percent of sales method. Super easy, and if we're not having to produce external financial statements, then why go to all the extra trouble? okay? Because we're going to look at an aging one example here in just a minute. But if, let's say that we're a calendar year company, and we're sitting here, we're at like January and February, okay? Why not? It's like 1%, 1.5%, whatever it might be, times credit sales. Boom, we've got like, what? A 30-second solution to a problem. We don't have to produce external financial statements in January and February. But in March, you're going to have to produce external financial statements. They're going to go to the bank. They're going to go to your customers, your vendors, your investors, everybody else. Now we're going to dig a little deeper and figure out what we need to do there. Okay? So let's start with an off month. So we've got the percent of credit sales method. Assume Simple Company had credit sales of $250,000 and cost of goods sold of $150,000 for the period. Simple uses the percent of credit sales method and estimates that 1% of credit sales would result in uncollectible accounts. So if we've got 1% of credit sales, we're using the credit sales method, how much during this month are we going to estimate is going to be uncollectible? $2,500. You with me? So $2,500 of the $250. You with me? Make sure you've got that picture going there. But it says before the end of the period adjustment is made, the allowance for doubtful accounts already has a credit balance of $250. Okay? Then they ask you, what amount of bad debt expense would the company record as an end of period adjustment? What do you got? Anything? Good. It is still $2,500. Sometimes they're going to throw, remember, we got to do this kind of stuff all the time, right? And we got to get hit to check my work on that one because that's an excellent insight. Okay? Remember, when we are using the percent of credit sales method, we are simply saying that's how much expense we're going to show in the period that the sales are occurring. That's the amount of the expense that we're going to use. All right, so when they ask you, get back over here. So understand what they're saying here. All right, we got our little T account. Our allowance has $250 in it. Okay, we've also got bad debt expense is going on. We just said $2,500 is going in the bad debt expense, and the flip side of that transaction is a credit to the allowance. So watch what happens here. There's a couple of things that could be going on here. Number one, they could ask you, like they did in this one, how much is the bad debt expense? Because they're trying to throw you off. We're intentionally trying to make sure it's like, do you really believe it, right? So when they ask for the expense like this one, the expense is $2,500. If they asked you, and I know where a lot of you were going, a lot of you were sitting there going, I think it's $2,750. I know it, okay? For those of you who are thinking $2,750, $2,750 is a valid number if the question was what's the new balance in the allowance account. Okay? All right, how would... And net accounts receivable changes. Good. You got it? All right. Now, how are we doing on percent of credit sales? I mean, that's kind of easy. The big thing here is percent of credit sales. Again, don't miss this. We're dealing with this bad debt expense debit and this credit to the allowance. we're dealing with that journal entry. We're just calculating how much goes into that journal entry. So when we get percent of credit sales method, that's the number that just gets stuck right into that journal entry. Okay? All right. All right, let's look at the aging method. All right, now look at this one. Remember, we're still dealing with the allowance, the receivables, and the bad debt expense. Okay, so in this one, it says assume the Simple company had credit sales of $250,000, cost of goods sold of $150. That's exactly the same. Simple uses the aging method. So again, try to get this picture going in your head. We're in a month where we've got to dig deep because we got to produce external financial statements. Estimates that the appropriate ending balance of the allowance for doubtful accounts is $3,000. Now watch what's happening here. That $3,000 is what we're saying is going to be the ending balance in the allowance T account. Okay? We're going to look at where that $3,000 comes from here in just a minute. Before the end of period adjustment is made, the allowance for doubtful accounts has a credit balance of $250. So we got a beginning balance of $250. We've got an ending balance. We've determined that the ending balance in the allowance needs to be $3,000. So how much goes into our estimate journal entry? $2,750. Okay, so think about what the difference was. Think about what the difference was between the last question and this question. Number one, they gave us the whole thing of percent of credit sales. We took the percent, multiplied it by credit sales, threw that number into the journal entry. And again, the journal entry that we're looking at is simply what's hitting the bad debt expense and what's hitting the allowance. Okay. This time, when we're dealing with the aging method, we start with how much does the ending balance in the allowance need to be, how much is already existing in the allowance account, and how much do we need to change it. So on some level, they talk about this in the book, on the percent of sales method, we're really focused more on what we're going to put onto the income statement. When we're dealing with this aging method, we're starting with the balance sheet accounts and backing into the expense. Okay. How are we doing there? Okay.
Is it always going to be where it gives you for the aging one? It gives you the beginning and the end?
Yes. Yes. When we're dealing with that aging method, we're going to have to count what we'll start with. In this one, they gave it to you, but we're going to have to calculate a little bit later. We're going to have to calculate what the ending balance needs to be. Then we'll already know how much is already in there, and then we'll back into how much we need to change that allowance balance. Okay? All right? So, at this point, look, it's the exact same company, right? A Simple company, credit sales $250, cost of goods sold of $150. Now, also notice too, this whole thing, cost of goods sold of $150, irrelevant for this question. Okay. It estimates that 1% of credit sales in uncollectible accounts when it uses the percent of credit sales method. Right. All right. So the 1%, remember that was the 1% of the $250,000. So the amount of the expense in that one was $2,500, right? Okay. And that was, and we calculated it, right? So this is the 2,500, right? That was just percent of credit sales. We got bad debt expense, and accounts receivable, the allowance for accounts receivable, okay? Super easy. Percent times sales, drop the number into the journal entry, okay? Then, on that second journal entry, then it says it estimates that the appropriate ending balance of the allowance for doubtful accounts is $3,000. Before the end of period adjustment is made, it has a credit balance of $2,50. So we backed into the $2,750. Okay. So if we were using that method, it'd be $2,750 for that journal entry, right? Again, bad debt expense and the allowance. Okay, so notice it's still the same journal entry for the accounts that are being affected, but they're just being affected by a different amount because we chose to use a different method to calculate that estimate. Okay. All right. Then it says, which of these methods is required by GAAP? Either one. Now, which one is more accurate? It's the aging method, because understand what's going into, so in this particular question, right, this $3,000 balance that they're saying needs to be the allowance balance at the end. Understand what's going in behind. We have printed an accounts receivable listing off of the computer system. It's aged by 0 to 30 days, 30 to 60, 60 to 90, and over 90 days is usually the standard format of that. We're over here under the over 90 days stuff, and we're looking at all those items, and it's like, do we think that each one of those items is going to be collectible? We could even have something that is maybe even 30 to 60 days, but we're already aware that there's some sort of problem with that sale. Like, we shipped something to somebody and it was destroyed during transit. Are we going to collect that money from that specific invoice? No, right? We're going to have to reverse that out and send another. Okay, so that's kind of what's going on behind the scenes in getting to this $3,000 number. We are digging into that detailed listing of the accounts receivable to determine specifically which accounts we don't think are going to be collectible. But again, we still behave like we don't know who because we're making just the estimate. Okay, because we might actually be able to, who knows. I'll give you a perfect example on something like this. Y'all remember like the week that COVID hit? Normally you know exactly where you were. I think I was actually standing in the classroom next door. I remember one young lady looking at me going, because we were getting this was like the last class before we were getting ready to leave for spring break. She says, you really think that something's going to happen? I said, yeah, I think we're done for the semester. She went, really? I'm like, yeah. Sure enough. It's like we had We had that next week to switch our classes over to fully online classes. And then basically had, we had, because they were face-to-face classes, we all had to switch over to like Teams, WebEx kind of stuff to do classes. But we all remember where we were, right? So think about this. You are a restaurant supply company, and COVID just hit. What's the problem? Yeah, you're sitting there and you're like, oh crap. Yeah. Because y'all remember that, right? And it was like, but well, it just depends. Well, one, on an ongoing basis, we're going to make this estimate every month. But in a situation where something like COVID hits, it's like we're definitely going to have to use like the aging of receivables method. And we're going to have to figure this out. Now, I will tell you, one of the companies or one of the restaurants that I thought handled that whole COVID thing beautifully. Anybody else like Showmars? I love a good Showmars, man. Okay? They handled it beautifully. Absolutely beautifully. Because they immediately went to online, ordering and everything else. And, everybody was just picking up, and you could pick up at the drive-through and all kinds of stuff and everything. They didn't hardly miss a beat. They also, by the way, because we were all caught little flat-footed, right? And what was one of the biggest issues that we had? Toilet paper. There was no toilet paper at the grocery stores. Okay, but understand, were the toilet paper companies still making toilet paper? Yes, they were. What was the problem? Well, people are a little bit crazy because everybody thought they had to have 500 rolls of toilet paper at their house, right? So then everybody went nuts, okay? But, okay, you couldn't go get toilet paper from the store, but could Showmars get toilet paper? Why? Not necessarily a different company. Different. Oh, this is where it all comes together, folks. Supply chain, right? So grocery stores are buying their product through a different supply chain. Showmars was like, yeah, we got toilet paper. Y'all need some toilet paper? We'll add toilet paper to your food order if you want toilet paper. They really did that. And I'm like, brilliance! Absolute pure brilliance, right? Showmars didn't have a problem. Anybody who sold to Showmars didn't have a problem. Now, were some places that capable of, and I hate this word, pivoting to the new reality? No. And a lot of restaurants went out of business. And if you are the restaurant supplier, you probably had a major problem with your accounts receivable. And what do you think happened to your allowance? It went sky high, right? Because you had no idea. It's like, oh, sweet mercy. And you're probably on the phone calling every single one of the restaurants that you're supplying product to and going, have y'all got a plan? What are y'all planning to do? What's going to happen here? Because you got our product and we need our cash. Do you have a plan? Okay? It doesn't fulfill. Okay, yes. All right, so remember, you got to go all the way back. We haven't gotten there yet, but we're going to do one. But when you go all the way back to chapter 1, every bit of this is making this estimate is all about fulfilling the matching principle. If we're going to show X number of dollars in revenue, we got to show all the expenses, even the anticipated expenses. And bad debt is an anticipated expense. Okay? So when we're talking about the direct write-off method, the direct write-off method is only for tax purposes. Because U.S. GAAP and U.S. tax code have two different focus for what they're looking for. Okay? When you're talking about financial statement purposes, we want to see estimates and things for financial statement purposes like bad debt expense. Uncle Sam's like, yeah, that feels a little loosey-goosey to us. Unless somebody actually doesn't pay you and you actually write it off, that's when we'll take that into account. Thanks for playing. You with me? So that's the whole issue with this thing with the direct write-off method. Because think about what happens there. You make a sale in... Now, and also understand this, and let me give you a good example here. So when we first moved to Charlotte, I got a job as a controller for a construction general contractor. And one day I'm just sitting there in the office and we get a check in the mail. And it's got, this legal letter with it and everything. And, it was probably like $15,000. I'm like, well, that's cool. I have no idea who this is. I don't know who this is coming from. There was no... it was referencing some company that I couldn't even find in the computer system. And I'm like, cool. I like it when people send me money that I don't know who they are. That's awesome. Okay. I go to the CFO and I'm like, this look familiar to you? He's like, oh, yeah. We did that job a couple of years ago. And, the company, one of the owners went bankrupt. But understand, this was like 3 years between the company going bankrupt and the bankruptcy actually settling. And us getting getting a little bit of our money back. Because I think it was actually like $100,000 that they owed us when we got like 15. Okay? So this whole thing of it's like, that's why I don't like how they do it in the book, because it's like they're acting like, oh, we wrote it off and then we reestablished it and then we collected it and wrote it off and reestablished it and I'm like, stop. No, right? Until we're pretty sure that it's non-collectible, we're not going to write it off. Okay? But in a situation like that, when the company, when you get the letter from the county court that handles bankruptcies, and they say, yep, this company is filed for bankruptcy, pretty good bet you're done. You're going to get pennies on the dollar for what they owe you, right? And that's when you actually write something off. Okay? You don't just let somebody walk. That's the reason why it's like, I don't know. It can't. Do what? Well, when you're actually writing something off for tax purposes, it does decrease your net income in the period in which the write-off occurs. But that's only for tax purposes. For financial statement purposes, it hits the income statement when we make the estimate. So think about it like this. Let's say that we do $100,000 worth of sales back here in 2022. We have been working like dogs for like 2 years to try to collect from these folks. They kept saying they were going to pay. They promised and promised and promised. We got maybe a tiny little bit, but never all of it. And then suddenly we get a letter from the bankruptcy court saying, yep, they filed for bankruptcy. And it's like, crap. Okay? Now, for tax purposes, let's just say that we still got $100,000 outstanding. That $100,000 immediately goes into bad debt expense for tax purposes and reduces the net income. That $100,000 write-off for financial statement purposes probably got booked and hit the income statement, I don't know, a year ago. So it's just a timing difference, really, between the two different methods. Because one, you're dealing with Internal Revenue Code. One, you're dealing with U.S. GAAP. Two totally different standards.
So are you saying like it's affected when it's happening? The write-off or
when you realize that you're not, when you've got absolutely pretty much confirmed information that says that we're not going to collect, then you can write it off for Internal Revenue Service. There isn't, so it's kind of hard to think about this unless you've actually seen it and been in the industry. But you've got on your, let me say it this way. You hear all the time that it's like, oh, this company has 2 sets of books, and all the accountants are going, yes, and what's the problem? Because one set of books is going to book an allowance for financial statement purposes. That's one set of books. The second set of books is Internal Revenue Code. So we report different numbers on our financial statements compared to the numbers that are on our tax returns. And that's okay.
When we get audited, they come in and compare those two. Is that
Depend who's auditing us? The Internal Revenue Service or the external auditors?
IRS?
Okay, if the IRS comes in, no, they're just going to audit their stuff.
So they don't care.
No, they shouldn't match, and that's the whole point, is that your financial statements, all that is not going to match your tax return.
your financial statement is more like the sustainability of your company or
And
your proof of how great you're doing or how bad you're doing.
right. But your tax return is just simply Internal Revenue. Let me give you 2 examples. One, this example. What's the difference between your financial statements and your tax returns? One difference between financial statements and tax returns is going to be this whole issue of how we deal with bad debt. Right? Financial statements, we book it and estimate it up front. And that's when the income statement gets hit. Internal Revenue Service, remember, if we did that for Internal Revenue Service, taxes, and use that net income number to calculate our taxes would be lower earlier. Uncle Sam says, no. When you're pretty sure, when you get the letter from the bankruptcy court, that's when we'll say it's ready to be deducted for our rules. Okay, so there's one difference between financial statement and taxes. Another difference between financial statement and taxes is depreciation. Financial statements allow for different kinds of depreciation. Taxes have one method that they allow. So we could use a different method of depreciation for financial statement purposes versus the depreciation method we use for tax. Yes?
Could you just, as an estimate,
Mm-hmm.
bad debt expense, could you just, does it matter if can you finagle it where you benefit, like you estimate it low or you estimate, I don't know.
Well, okay, yes, and that's actually a really good question. So I'm going to answer this question, then we're going to take a break. So here's the backstop. Number one, you don't want to overestimate it and you don't want to underestimate it. Okay? I know, right? But you have to remember, accountants don't have crystal balls. Right? I mean, we can't perfectly see the future. We make a lot of estimates. Okay? And if our allowance balance is constantly going up, that means we are under or overestimating. We're overestimating, right? Because if the balance is constantly going up and we're not writing anything off, right, the balance in the allowance is going to continually go up. If that starts to happen, then we realize that we either need to figure out what the real percentage is, or maybe we were always using the percent of credit sales method without digging into the aging method, and that's the reason why that was going up. So maybe it was our policy for our percentage, or it was our policy because of which method we chose. The aging method usually sort of tamps that down just a little bit, because again, we'll use, like on off months, like in a January, February, where we don't have produce financial statements, we use percent of credit sales. Super easy. We get into March, we got to produce external financial statements. We dig into that whole list of accounts receivable and go, okay, all right, how's it going and what do we really think is collectible? Because if we've got $800,000 on our accounts receivable listing and we really think that 750 of that is actually collectible, then our allowance balance should show 50. So they kind of balance each other and sort of give and take and ebb and flow to make sure that we're not overestimating and we're not underestimating. Well, somebody's going to ask the question, if you're overestimating, number one, remember, if you're overestimating, you're making your net income on your financial statements lower. Okay? And at some point, your investors are all going to go, what are you doing? Right? Because not only is your net income lower, but this allowance balance is going up. Somebody's going to ask the question, what are you doing? Because that's not right. If you're underestimating, understand this, and we haven't even talked about this part yet. If you're underestimating, that means that you are making your net income look better than it is. You with me? But what's going to happen is you're going to get a little too many surprises when you end up having to write off more than you're estimating. And that's another one of those things that investors don't like, surprises. So there's a checks and balances here between trying to get this right.
You're not allowed to write off until you know for sure that's not going to be.
Yeah. Yeah, you exactly. You need to know exactly who it is before we get to actually write it off. Whether it be writing it off by removing it out of the allowance or writing it off under the direct write-off method for tax purposes.
And they're doing this every month?
Yep.
This is just for like obviously bigger, major companies
No.
or smaller
It,
companies.
okay, also understand the other thing that's in play here. Again, go all the way back to chapter 1. You remember the concept of materiality? If it's material, then we have to estimate it. That's the rule. If it is immaterial and just so rare that we ever write anything off, we don't have to do anything. So again, lots of checks and balances here to make sure that it's like we're getting it on the books if we need to, but we're not going to force a company who's sitting there going, we've been in business for 5 years and we haven't written anything off and we're not really sure that we ever will. Okay, well then don't make an estimate. Context matters. Okay, let's take a break.